Talking about a human tragedy in economic terms is never an easy thing, and it rarely feels like the right thing to do. The events that unfolded this week in Canada sent ripples around the world markets for a reason, though, because whether it's acts of terror or the spread of Ebola, fear can cripple economies. It's why George Bush told Americans to keep shopping after 9/11. What we do next is important. It's the moment when we collectively refuse to be cowed. MPs are back at work and markets have recovered. How we do so is up to us. Yesterday's traumatic events cast a long shadow over our nation's capital. The entire country paused, including at the Bank of Canada, located just steps from Parliament Hill. Its regular press conference was one of the many events cancelled yesterday. It did release its monetary policy report as scheduled. The bank didn't change rates as expected, but the report contains some red flags we thought we'd like to share with you now. In its latest monetary policy report, the bank said a soft landing remains the most likely scenario, but that the combination of high house prices and debt levels leave households vulnerable. If a soft landing doesn't happen, it increases the likelihood and potential severity of a correction later on. In other words, yes, we understand money is cheaper than ever and has been for nearly 5 years because of low rates, but we're warning you yet again, don't expect it to last. Rates will go up. The bank can't say when they'll go up. Analysts, though, are pointing to sometime next year. The Bank of Montreal warned this week an interest rate rise of 2 percentage points would make mortgage payments unaffordable for most Canadians. Also today, Moody's warned our car buying is in overdrive too. In 7 years, auto loans by banks have jumped from $16 billion to $64 billion, 20% a year. This chart shows the percentage of new car financing for 72 months or more. Those low interest rates are pushing us apparently to buy pricier vehicles. We take longer amortization terms to afford them. That means consumers are getting more car for the same payment and increasing their overall debt load. Then, after those 72 months of driving it, in many cases, the car you're left with is worth less than what you owe. According to Moody's, that puts both consumers and banks at risk if our economy goes south. The CBC's Peter Armstrong is with us now. And I was alarmed by a couple of things. I was alarmed at the rate of increase of bank lending for car loans. Now, we don't know actually, they don't break out the numbers, so there's a little bit of guessing around how much of this is auto-related, but I think you can come at it the other way.
How many of these people used to lease and are moving over to, and if we're looking at sort of a situation in which there's a financial crisis so bad that people are needing to get rid of their car, wouldn't you be better off having a car that you own and owe some money on than a lease that you can't get out of? I get it, and there's significant problems, but we don't know where all these people are coming from.
Yes, and of course, the banks, and I'm sure we'll hear from the good people at the CBA today, will say that they monitor the credit risk, etc. Sure. What Moody's is saying, though, is that the banks are actually putting themselves at considerable risk because they don't have any collateral. When somebody has an asset that it now has more debt on than value, that's bad collateral. The number that I think is most important in the context of what the Bank of Canada is saying, right? Because the Bank of Canada is saying even a 2% move makes many people's mortgages unaffordable to them. Well, you may not be able to make your car payment in that case. Why 72 months? Why the sudden love of this long amortization on cars?
Because we love buying things that we can't afford. I mean, and it took the Fed stepping in on the mortgage side to keep the amortization from going completely out of whack. True. And it would have continued if the Feds hadn't stepped in to do that. And in this, you're seeing people that say, well, I could afford $250 a month for 5 years and get a car and everything will be fine. But if I spread that over, and I mean, it will only continue to grow until somebody says, okay, that's enough. So, and the risk balance.
The thing that's interesting about this is it isn't just that we want cars. It isn't just that there was a recession and we put off getting our new car. It's that we want non-domestic made cars. We want fancy cars.
We want particular cars. And I think there's a psychological analysis to be done about the effect of 5 years of, this is normal to us now. We can't imagine having 4 or 5% interest rates because it's been what, since the 1950s was the last time we saw this long of a stretch of this low interest rates.
And no move.
And no move. And no real indication that it's going to move anytime soon. I know we keep saying sometime next year. We were saying that this time last year,
I still think they're going down before they go up.
Do you really?
That's my pessimistic view. Yes, but that's a whole other debate.
We'll have that conversation another time.
But to me, it does get to this question of, are we completely in over our heads and not paying any attention to the fact a 2% move would only put us at 3%.
Oh, for sure.
On the lending rate, and that on the overnight rate, and that is absolutely still rock bottom levels compared to where we've been. 4 to 5 is where you should expect to land.
And that's where I sort of come back to this issue of the psychology of it. That, like, you know, somebody broke it down that a 2% higher mortgage on $300,000 mortgage, 2% interest rate hike would see $300 more a month. That's not a ton
You
of
would
money,
think.
and that's like 67% of Canadians would find that untenable.
Yes.
Nobody's building in cushions for themselves anymore, and
Yeah.
I think that's an important thing that, you know, we hear from advisors all the time. Give yourself a little bit of a cushion because this is normal, and it's, you know, we're just trying to stretch our dollar as far as we can. We're not making the same.
Well, you know, the number
decisions.
that jumped out at me from that BMO report was where you get the 67%. 13% of first-time home buyers would be out of the market with a 2% interest rate hike. 13%.
But like 20% would be, they say that it would be way too much for me to buy, but I'd buy anyway.
But I'd get in over my head. Perfect.
Be careful.
Thanks, Peter.